Good morning. Thank you for joining today's daily webinar. As always, today's webinar is for educational purposes. Thinking about borrowing from your retirement plan? You might be wondering, can you take a loan from a solo 401k? The answer may surprise you. Whether you're looking to grow your business, manage short-term expenses, or just want to understand all the participant loan options your solo 401k offers, this webinar is for you. Please also subscribe to our channel for more educational content and to receive notifications of upcoming webinars. In this webinar, we'll be breaking down everything you need to know about solo 401k loans, including who qualifies, how much you can borrow, how repayment works, and the big risks you'll want to avoid. We'll also clear up common myths, like, can you really use solo 401k loan to fund the business? What happens if you miss a payment? And is it a good idea to borrow from your retirement savings at all? Here's what you'll learn in this session: eligibility rules for solo 401k loans, how much you can borrow, up to $50,000 in some cases, how to structure your loan to stay IRS compliant, what to watch out for so your loan does not become a taxable distribution. This strategy isn't for everyone, but if you are self-employed or run a solo business, knowing your loan options should give you critical flexibility, especially when cash is tight. So the eligibility rules for solo 401k loans is, first, you have to make sure you open a solo 401k plan or have a solo 401k plan that allows for participant loans. Not all plans allow for solo 401k participant loans. The plan offered by my solo 401k financial does allow for solo 401k participant loans. So that's number one. Second, how much can you borrow? Well, it comes down to the statutory limit, which is 50% of your total balance in the plan, including all investments, not to exceed 50,000. For example, if the value of your plan is $100,000, the maximum you can borrow is 50,000. Example two, if the balance of your plan is only 60,000, then the maximum you can borrow would be $30,000, because 50% of 60,000 is 30,000. As far as how the loan is structured, well, it's got to be structured based on IRS required loan documents. So there has to be a loan application, a loan agreement, and a loan payment schedule. All of the above are provided by solo 401k plan providers. And it has to be specific loan documents. It cannot be a loan document that you draw up, but rather it's got to have specific language applicable to the solo 401k participant loan rules. Now, as far as what to watch for so it does not become a distribution, well, A, you need to make sure that the plan allows for loans. B, make sure you don't borrow over the allowed limit that we just discussed. And then C, make sure you make the payments back pursuant to the loan payment schedule. If those payments are not made timely and by the grace period, which is generally the end of the quarter following the quarter in which the loan payment was due, then the loan goes into default and you have to treat it as a taxable loan distribution. However, you still have to pay the loan back. So just because it's treated as a taxable loan distribution, it doesn't get you off the hook of having to pay that loan back. And when you pay that loan back, you're going to have to make payments into a separate holding account dedicated to hold those payments that you make after the loan went into default. So you don't want to get into a situation where you think you can just borrow from the plan and let the loan go into default and not have to pay it back. Not only do you have to pay it back, but you're going to have to treat it as a taxable distribution. So it can be a real nuisance if you don't pay that loan back. So those are things to understand with respect to when a loan becomes taxable. So that's why this strategy is not for everybody. So you want to make sure you try to plan ahead to make sure that you don't get into a situation where you cannot pay the loan back. Because that interest is going to keep compounding until that loan is paid back in full. Now, let's talk about some of the other loan requirements. So when you process the loan, and we already talked about the required loan documents, you have to make payments either monthly or quarterly over a 5-year period. The only exception to the 5-year payback period is if you're going to use the funds towards the purchase of your primary residence, in which case it can be extended to a 15 or 30-year payment period. And the loan interest rate is the prime rate plus 1%. It's a fixed interest rate determined at the time of the loan. You make payments back consisting of principal and interest or fixed payments. You can certainly pay the loan back early without a prepayment penalty. So those are things to understand regarding the solo 401k loan rules and regulations. You can also have multiple loans. You just can't go over the overall limit of that 50% up to 50,000 between all of your outstanding loans. So it's not $50,000 per loan, but it's aggregated between all your loans. So it's not a good idea to have multiple loans because you're going to have separate payment schedules for each loan. So now you got to track separate loans. So if you do need to have multiple loans, you cannot go over the aggregated limit of 50%, not to exceed 50,000 between all loans in aggregate. All right, those are the main things we wanted to cover today. We'll be back live again today at 1 p.m. Pacific time. As always, thank you for joining today's daily webinar. Please subscribe to our channel. Please like it and share it with others in your network to help get the word out to other solopreneurs like yourself. Looks like we got a couple questions here. Let's take a look at those questions. So, Schedule C shows 18,000 income. Also, an oil and gas partnership on Schedule E shows 70,000 loss. How much can contribute? Well, contributions to a solo 401k plan are based on your self-employed business. They're not based on Schedule E. That's not considered self-employment income. That's investment income. So that doesn't qualify. Therefore, if you're self-employed under a sole proprietorship and you file a Schedule C, then your contributions will be based on your Schedule C. And if it's a Schedule C, and if you have $18,000 of net self-employment income for tax year 2024, you can plug in that $18,000 to our solo 401k contribution calculator, which will reduce 1/2 of self-employment income tax. And then the difference is the amount that you can make to the solo 401k as a contribution. Let me give you I'm going to share a link to our solo 401k contribution calculator here that you can use to calculate those the contribution amount. But again, only earned income from self-employment income qualifies. Therefore, investment income does not qualify. So Schedule E income does not qualify. So it doesn't matter whether you had Schedule E income or not, you cannot use that. Nor does it impact your contributions to your solo 401k plan. Let's see here. I'm trying to locate the contribution calculator here to provide to your that you can use for calculating contributions here. So, give me a moment here while I locate that here. Where is it at here? Contribution calculator. It's on our website. Contribution. Just a moment here while I locate that calculator here. Contribution. Okay, here we go. Let me share that with you here. You can use that to calculate your 2024 contribution or even your 2025 contribution. Okay, got another question here. See here. My maximum profit sharing contribution is 31,783 for 2024. I got an extension to file until October 15 of 2025. It looks like with Secure Act, I can now make employer profit sharing contribution as Roth. I believe it would require a 1099-R. Is that correct? Can it be split up, designate some Roth, some pre-tax? So yes, you can make employer Roth solo 401k contributions. It's still going to result in a taxable event because when you make employer Roth solo 401k contributions, it's treated as a pre-tax conversion. But you want to make sure to complete our Form 1099-R, excuse me, our Form 1099-R request on our website so that we collect the necessary information to issue that Form 1099-R. Now, that Form 1099-R will not get issued till next year because even though you're making the contribution here in 2025 for 2024, the Form 1099-R rules require that it's taxable as a conversion occurred in 2025. So the Form 1099-R will not get issued till January of 2026, and it'll be treated as a taxable pre-tax and planned conversion. Let me share that. Here's the link to that pre-tax and planned conversion form that you'll want to complete so that we collect the necessary information to issue that Form 1099-R. And yes, you can make some as employer Roth solo 401k contributions and some as employer pre-tax solo 401k contributions. You don't have to treat all the employer contributions as Roth or all the employer contributions as pre-tax. You can split them up. Regarding your follow-up question, yes, it's 1/2 of self-employment income tax needs to be 1/2 of self-employment income tax will be reduced from line 31 of the Schedule C. Line 31 is the net self-employment income figure. You need to plug that line 28 of that Schedule C to our contribution calculator, and the contribution calculator will reduce that 1/2 of self-employment income tax from the line 31 for you, and that'll give you the amount that you can contribute to the solo 401k plan. Okay, again, thanks for joining today's daily webinar. We'll be live again today at 1 p.m. Pacific time. Until next time, have a great rest of the day.